Okay, it is 12:01, and out of respect for everybody's time, we're going to go ahead and get things kicked off. Lisa or myself will bring everybody else in as they boot into this session here for July, which is talking about leveraging charitable giving. But before I get that, the Owner Fireside Chat series is designed by Prometis Partners. We are value growth advisors and exit planning specialists. So we work with privately held companies on not only increasing value within the company, but also structuring the type of strategies for exit to move the owner to the next phase of their lives, and obviously bring in new ownership into the company. So if you have any questions, you certainly can reach out by email through our website, which we'll have at the back end of this conversation today. So with that said, Lisa, let's go ahead and go to the next slide and introduce Paul. Paul Damon is our panelist today that we're going to be talking to. Paul is the owner and founder of Family Capital Management in Grand Rapids, Michigan. I've known Paul for a few years, and just a great individual, has really great integrity and character. He's built such a great firm over there with Family Capital Management. And also, we're talking to him about certainly charitable giving. Paul has been in the industry since 1981, started his own firm around 1999, and certainly has built it up significantly since that period of time. And he has done a tremendous amount of charitable giving over that period of time. Paul is married to his bride, Dawn Damon. Certainly they have 8 children, which is a big family around Thanksgiving Day. So, man, that's a lot of turkey, Paul. Oh, my goodness.
Oh.
Yes. Wow, that's a whole lot. Paul also serves as a CFO, and then certainly very active in the community. We're very fortunate to have him here. He is an expert in this area, and so we wanted to make sure that we had some opportunity to speak with him, and you obviously share that information with all of you. So you kind of see where Paul went to school. He went to college at Hope College, graduated in 1981 with a BA in Business Administration and Psychology. Also, in addition, he has the following professional designations. He's a CFP, CLU, CHFC, and a certified advisor of philanthropy, which I think is fantastic. So, Paul, thank you so much for being here. Really appreciate it, and thank you for certainly making yourself available to have this important conversation.
Thank you, Vince. Thanks for inviting me. I really appreciate the opportunity.
No worries. Let's go to the next slide, Lisa. So, let's talk about what some of our discussions are for today, and some of the learning objectives are going to be, and certainly understanding the power and leverage of using your business for philanthropic impact, which I think can be really, really awesome. Some of the other areas that we can look at business, certainly philanthropy, is business entity opportunities and limitations, triple benefit strategy, real estate, which is the perfect partner for charitable giving, and then certainly avoid taxes, generate income for you and your family, provide for your favorite charities. So we got a whole agenda of learning objectives today that Paul's going to talk about. So, Paul, let's go ahead and start talking a little bit about understanding the power and leverage of using your business for a philanthropic impact.
Sure. Yeah. Thanks, Vince. There's
let me just interrupt you one quick second, though, Paul, before you get started. I'm so sorry.
Sorry.
For those who are on the call, there is a chat box up at the top of your Teams meeting. Go ahead and type in a question if you have any chats or questions you have, and we are monitoring that. We'll make sure we get those questions out. So sorry about that, Paul. Go right ahead.
No, thank you. Yeah, there's just so many opportunities and so much leverage that we can have with a business when we integrate that with philanthropy and charitable giving. And so that's what really gets me excited. I always say to people, this is why God created me, was to help me for me to focus and my passion around helping people really integrate philanthropy into their overall planning. So financial planning from a traditional sense, or wealth management from a traditional sense, tremendous opportunities there to build wealth and grow wealth and do a lot of good things. And part of what I think makes that really special is when we can use that asset, the business assets, the wealth that we've been blessed with, to really do good for other people and to impact the world and the community around us. So whether it's local or regional or national or international, I think, Vincent, you know that there's unlimited opportunities and unlimited needs for capital in every area of philanthropy and nonprofit. So that's really what I love doing, what I enjoy doing, and having the business be part of that is really what gets me excited and gives me reason to get up every morning and go to work.
Yeah, I think it's important for our listeners to understand, and Paul, correct me if I'm wrong, I mean, with so many business owners transitioning out of their business, we know that there's going to be a tax liability on that.
Yep.
And so, certainly you don't want the tax tail to wag the dog, as we always say, right?
Yep.
But a business from all practical sense and purposes is kind of it is part of the community that's there. And if there's a way to give back to the community and certainly extend some other things within your designated community, I think it's a great way to take a look at how can you leverage that. And then with the kind of like the icing on the top is that, hey, you do get a pretty substantial discount from the IRS when you do that. So I think that's great. Sure. Let's talk a little bit about business entity opportunities and limitations and kind of talk a little bit about what do you mean by that?
Sure. So they're all different kinds of business structures, right? There's C Corps and S Corps and partnerships and sole proprietorships. So some of them are more conducive to charitable planning than others. So one of the better structures is a C Corp. Tends to be cleaner. You can gift shares. And by the way, with philanthropy and the planning that we're talking about, it really is best to do it prior to selling or prior to transitioning the business, if possible. That can avoid a lot of capital gain. So yeah, so the opportunity to use a C Corp is ideal. An S Corp can be structured in a charitable strategy. It can be done, and we do it all the time. It's not quite as tax efficient, so there's a little less tax savings, but really still great opportunities. Partnerships, sole proprietorships, there again, it can be a little more tricky depending on whether it's an entity sale or an asset sale, and so there's just more research and more understanding that needs to be reviewed prior to executing any transitions. But going back to the learning objective, just for a moment, Lisa, if you can go back one slide. The triple benefit strategy really relates to the bottom one. I should have combined those. And that is the power of this, Vincent, is that you can avoid a lot of taxes up front. You can use those tax savings to generate a lot of additional income for you and your family. And in the end, when you are promoted, then the remainder goes to your favorite charities. So it's a triple win, if you will. The IRS loses. So, if that's your goal, is to make the IRS happy, then this is not the best way of doing that. I say that tongue in cheek, obviously, because I don't think too many of us are trying to make the IRS happy. They tend to get a lot. Just to give you a quick example, last year, someone that I am working with now, we weren't working last year, sold his business for $60 million. There was no planning, no strategy. Nobody talked to him about charitable planning or really any kind of planning. Ended up paying $10 million in taxes. There was no charitable integration. So there's just a tremendous loss of wealth and opportunities that could have come from that. And now today, one of the challenges for business owners when they sell is what's their purpose. So not only is there a financial hit, but without proper planning and conversation around your what's next, you really can see people struggling in that phase of life. When we sold our business, that's a big part of what our life's been about. And now what do we do? What are we about? What's our purpose? And again, philanthropy can fill that bucket or fill that need along with other things. But so that's really why it's so important, is to make sure that you're leveraging those dollars. And I'll talk more about another case example where I can show someone that by integrating philanthropy into your planning, especially exit planning, you can actually have more money for yourself, more money for your family, and more money for charity. And what a powerful win-win-win, right? So that's what I love doing, is showing people the power, the leverage here that we have.
Awesome. Yeah, thanks for that. I think it is important for people to understand that. Paul, let's talk a little bit about, before we get into some of the case study stuff. I mean, as you talk to people across the country about philanthropic giving, right? And especially business owners using the business as a charitable contribution, so to speak, and looking at different strategies. Are they really what are some of the reasons why they do it other than just for the tax deduction?
Sure. Yep. Yeah, because they want to make a difference. They want to give back. Many business owners, probably most of them that I talk to and work with, feel like they've been blessed by the community that they've operated in, whether it's local or national or even international. And so they recognize that their business is successful because a lot of their hard work and a lot of what they've done and their key, their employees and part of the organization, but they also have been blessed by the community that they're in. And so they see that opportunity to give back as something that's important to them. So they are doing it for more than just tax benefits. In fact, I personally feel like if it's just tax benefits, it's not a good reason to do it. And so I don't encourage that. But Lisa, if you can go to the next slide, because this really gets at the heart of what you asked about, Vincent. And for many people that I work with, stewardship is important to them. And it's a faith-based approach, and not everybody views life the way I do or the way someone with a faith-based approach does. But if God provides us with the blessing of resources, then how do we best use those resources to benefit others? And again, our family's part of that, ourselves and our family. Nothing wrong with enjoying the wealth and the growth of assets that have been part of our lives. But stewardship is certainly a piece of that. Generosity is a piece. In fact, research has shown that generosity actually has a lot of benefits for us personally. First of all, people that are generous live longer, which I think is great. They live healthier. They have a more healthy life experience, emotionally, physically, and spiritually, and they enjoy life more. I've always asked people that I talk to, have you ever met somebody who's generous, who's unhappy, who's miserable? And I haven't. I've met a lot of people, not a lot. I've met some people that have a lot of wealth and are not generous, and quite often they are not real happy. So generosity, I think, is a core to living a happy, healthy, successful life. And then philanthropy. Many people we work with, even if they don't have a stewardship focus or a generosity focus, again, they like to think about how they can benefit others and how they can give back and how they can make a difference in the community. And sometimes, there's some recognition that goes with it. Nothing wrong with that either. Nothing wrong with having a building with your name on it if you made a significant gift to help make that happen. That's my personal opinion.
Yeah, I think that's great. So how does philanthropic work when you're gifting on an annual basis, whether it's 10% or the full gifting limits that are out there through the IRS? Does this have the same benefits that you would have by, let's say, gifting a business towards when you're getting ready to transition out?
Yes. So one of the things that we're working on right now, which I'm really excited about, is business owners who want to give a portion of their business without selling it, but give a portion of their business to a charitable strategy that they get a tax deduction when they do that. So let's say I might have a $10 million business, and I want to give 10% or $1 million of that to a foundation called a donor advised fund. We'll talk about that in just a minute. So giving that 10% or $1 million of my business to the donor advised fund, all the profits from the business, 10% of them go into that donor advised fund pre-tax. So there's not a taxation on that income. It automatically goes right into the foundation, and then it can be given out. And what we're actually doing now is if we can get more and more businesses to do this, then we can go out and buy additional businesses and leverage that wealth to create more money for charity. So we're really excited about this, and I'm working with a couple guys, some of them you know, Vincent, who are local, who we're working on putting together these kind of strategies to really grow the pool of assets that are out there that could be used for philanthropic purposes.
Wow, that's great. So if you're giving away cash of, let's say, a portion of your profits, this would really probably be a better utilized strategy to move forward.
Absolutely, because you get $1 million tax deduction now, right? You don't have to wait for later. You get the income tax benefits of not paying taxes on that income. It doesn't even flow through your cash flow and your taxation. And then you're able to use those funds to, again, make gifts or potentially go out and buy additional businesses. Yeah, so it's really exciting.
Awesome. Okay. Robert, I hope that answered your question. If you have any more, that was from one of our listeners here, Robert. He had the question, so I think we got most of it answered. But if there's other pieces of that, Robert, you want to answer, certainly let us know. I'll be happy to get with Paul and expand on that question. So let's go to the next slide, Lisa, and let's talk a little bit about, so many ways that everybody can do some gifting. And remember that there is a chat box at the bottom of your teams. Actually, you're probably at the top. And you can ask a question through the chat box. So let's talk about the 4 ways of charitable giving, certainly tax, estate, legacy, and retirement. So
sure.
Paul, why don't you kind of run everybody through a little bit about what all of this means, what they're looking at?
Absolutely. So philanthropy or charitable giving can impact every area of our life, but these are 4 areas that we really emphasize and really focus on because there's such a big impact, such a leverage opportunity. So the first one is taxation. That's kind of an obvious one that many people benefit from. So if you give your business or any asset that's appreciated prior to selling, you avoid the capital gain. So if I make a gift of $1 million of my business and my basis or my tax basis is $100,000, for example, I avoid that $900,000 of capital gain. Well, at 23% or whatever it might be, that's a lot of taxes avoided. It can eliminate estate tax. We always tell our clients estate tax is always optional. There's always ways of avoiding estate tax, and charitable giving pre-sale, post-sale, or integrated throughout lifetime could really eliminate. And we've helped some people move some very significant size estates to charities and the next generation, kids, grandkids, et cetera. Again, all without paying any estate tax. So that's a really important point. You can significantly reduce income taxes. So if, for example, I've got 100,000 or I'm saying $500,000 of income, ordinary income, and I gift part of my business or all of my business to a charitable trust, the tax deduction on the charitable piece offsets the ordinary income, can offset part or all of the ordinary income. So you're an asset that would be taxed at capital gains, which is favorable, better than ordinary income, could actually be used to reduce your ordinary income and get you a much larger tax benefit. So right now that, that's in the high 30% on ordinary income, but that if we don't have some kind of a change by 2026, it's going to go back up to more than 40%. And so I think we all know that the government wants and needs more money. So we do believe taxes are going to continue to go up. And then you can even use charitable planning to eliminate taxes on your retirement plans. And so many people are not aware of that they can reduce or eliminate taxes on their retirement plans using charitable giving. So taxes is a big one, but not the only one. The next one that we talk about is estate planning. And I link estate planning and legacy planning together because they're so closely related. But
they are.
With estate planning, and you probably see this a lot, Vincent, is, what do you want for the next generation? What do you want for your legacy to be? So when you're promoted to the next life, what do you want to leave behind? Well, you're going to leave all your wealth behind. You can't take that with you. But many of our clients want to leave their values. They want to leave their generosity, the philanthropy. They want to have a lasting impact, not just on their family, but also on the community. So proper planning can really align our goals and objectives with whatever documents we put in place, whatever our trusts and our wills and all the charitable strategies that can be used. And we'll talk about those in a minute. But it all can be done to make sure we eliminate or avoid probate. We avoid the pitfalls that we commonly see in estate planning that are missed. We can protect and provide our heirs, and we can be a blessing to nonprofits. We often ask our clients, you're very generous and you support your church or charities very, very faithfully. When you're gone, who will step in and will continue supporting those great organizations and great causes? Well, with proper planning, we can provide a legacy of giving that continues on even when we're gone, and so that's an important piece. The whole area of legacy planning is very important, again, because it's what continues on when we're gone. The money doesn't, it's given out or distributed, but that legacy, our value system can continue on in the next generation. So a lot of times we'll use the process of philanthropic planning to help encourage more of that and enhance that. For example, we'll talk about a donor advised fund in a minute, but we have many clients who establish a donor advised fund during their lifetime, and they have assets in that fund, and they might even have more assets going into it when they get promoted. But then that fund is there for their kids and grandkids to give out. And just the joy of seeing that family coming together and, hey, what would mom and dad want us to do with this money? How can we use this money to be a blessing to, again, charities that were important to them or organizations that they supported, or what new ones could we consider supporting? So it's that environment of stewardship and responsibility and charitable opportunity. I'll stop there. Do you have any questions before going to retirement?
No.
Okay.
The one question I wanted to ask and have a brief discussion on is, certainly with different family members in the family, when all privately held businesses to me are family businesses, but especially when you have children that are working inside the business and then you have children that are not working inside the business. I would suspect that some really good estate and legacy planning is going to allow you to sometimes, equal does not always mean fair to
Right.
everybody, right? And sometimes
Right.
the kids not in the business may not get as much, but it's also part of that process. And I think that helps people work through that. Would you agree?
Yes, very much so. And it's interesting. It's a good thing to bring up, Vincent. Thank you. But if you think of three circles: family, business, and then ownership, and where those intersect, for example, somebody who's a family member, maybe a child or a grandchild, they are part owner of the business, and they work in the business. So where those three intersect, that's a highly engaged, highly involved person. But you might have somebody whose family who's not an owner and doesn't work in the business. You might have somebody who's 2 out of 3. So it gets pretty, it can get pretty complicated and it can get challenging. And by the way, this issue of legacy and family legacy is probably the most difficult that people really have to wrestle with and deal with. Like, how much is enough? Like you can leave so much to somebody that it can ruin them, or it can fund a lifestyle or bad decisions that could really affect their life negatively. So, more isn't always better, and unlimited is probably not a good plan for our legacy. And so, yeah, one of the ways that philanthropy can be used is to help in that transition. We're working with a client right now who's got three children, all part owners and will be owners, and when our client is promoted, but one doesn't work in the business, and then a couple of the in-laws, their spouses work in the business. So part of the way that we use philanthropy is by putting some of the stock into a charitable structure. Then the kids or future generations can actually get money out of that charitable structure on a tax favored basis to help transition the business from one generation to the next. And so that's a great way of avoiding a lot of taxes and accomplishing the goals of the owner.
Yeah, we have a question, Paul, I'd like to ask you. What are the thresholds for doing these types of things? When does it make sense for a business to set up these kinds of accounts or strategies, let's say, and then specifically asking for a business, let's just say is between 150 to $250,000 right now, but is on a growth plan for $1 million in the next 3 to 5 years, specifically from a cost and benefit basis. Is that a strategy that type of business would be utilizing?
I don't know all the detail, but I'd say probably not yet, Vincent. I would think that maybe something maybe closer to 3 to 5 million of total value, because then you could peel off half of that or a quarter of that, or a smaller amount of that. Even 10% would be a good charitable gift to look at.
Okay.
There is some cost in these structures and putting them in place and managing them. And so, yeah, you'd want to make sure that the cost benefit on that would be enough to justify the strategy.
Okay. All right. Thank you. All right.
Yep.
Let's go ahead and go on to retirement a little bit and talk a
Okay.
little bit about some of the retirement in the charitable giving.
Yep. So retirement is an important part of the process. So these charitable structures that we talk about, they're really useful in generating additional cash flow. So, the business or an investment in real estate or just an investment portfolio may not be producing a lot of income. Transferring that into a charitable trust, we can set the income at a level that's higher than what they've been experiencing. If they want more income, we have some flexibility to control it even. So the charitable structure is tax-free, so there's no taxes as it grows or generates income, as long as it's not paid out to individuals. So it can allow someone to accumulate more wealth because they're avoiding taxes as it grows. And then later on, they can use that to distribute wealth out to them in retirement. So we can actually use charity much like a retirement plan, a 401k or a qualified retirement plan, but there's a lot less restrictions on it, and you don't have to do it for everybody, right? So I can set up a charitable plan for myself. I don't have to include my employees if they're not interested or don't want to participate. I can just do it on my own. So there's a lot of benefits around charitable planning structured together with retirement planning for cash flow management, for increasing income. One of the case studies I'm going to share towards the end was exactly that situation where a couple wanted more income, and the charitable planning allowed us to get them a lot more income than they were generating.
Yeah. Can you tell our listeners, Paul, do we have an idea of about what percentage of businesses that are sold are utilizing any type of charitable giving or philanthropic strategic planning?
Yeah, it's not enough.
Yeah.
I wish it was 100%, but I would say roughly 10%. And one of the things that makes it challenging is it's best if it's done prior to selling, and it's best if it's done, even a year or two prior to selling, because when you so often, Vincent, you see this too, is that the whole process of selling can happen so quickly, and it can be so hectic that there's just not enough time to integrate that and add that into the process. And then there's always the questions about the buyers, and they're buying the business, but they're buying it maybe partly from the owner, the individual, but partly maybe from a charitable trust. And so that brings up questions. And I'm working with a client right now that's selling their business for $60 million. And we started talking a couple months before there was even any offers made, but their attorney really discouraged in doing it pre-sale because the complexity of that added kind of at the last minute, and the buyers might be hesitant, and there's reps and warranties, as you know, that are involved, and it's just more involved. And so the attorney actually said to my client, he said, "We wish you'd have started this 3 years ago, because then we could have put it in place, had all those details and the minutia worked out, and then we could have had a much easier transition." So my encouragement to you and all those who are listening, or who will listen to this, to do it as much as you can well in advance of thinking about selling, so that even if you don't do it, you've studied it, you've analyzed it, you've made sure that you're going into it and you're making a decision with good data, good information, and a good understanding of the benefits, the costs, and maybe even the disadvantages, because there are disadvantages to almost any strategy.
Yeah, there is. We have a question. Scott, did you have a question? If you want to unmute your computer, or you can put the question inside the chat box, I'll give you the choice there.
Sure. I understand, obviously, the tax benefit of the gifting of the whatever share to the contribution, and I also understand that would lower your individual or your business profit based on how much you have gifted. But where does this cash flow, you talked about adjusting cash flow to the owners, how does that work? Or is that in the form of the tax benefit of the portion that was gifted to this contribution? Does that make any sense? Sorry.
Yes.
Great question, Scott. Great question.
And I'll answer that more on the next slide, but let me just say this before we go there. There are different types of charitable strategies. And so the donor advised fund is a foundation that whatever you give to the donor advised fund, everything that comes out of that has to go to charity. So that's a pure we call it a giving engine or a giving vehicle. So if you put part of your business, say 10%, into a donor advised fund, whatever income the business makes, 10% of that isn't clocked to the business or recorded to the business. It's recorded to the donor advised fund. And then that money can't go to the owner or any individuals. It has to go to charity. But there are strategies that are called charitable trusts, where there is income to the owner or the donor, where there is income to the family potential, or income to charity. But it's called a split interest gift, because it allows you to get a double benefit. There's income to you or income to charity, and then the remainder to you or the remainder to charity. Why don't we transition to the next page, Lisa, and I can get into this in a little more detail. So hold that question, Scott, because hopefully I'll answer it now, but if I don't, please come back and ask it again, and I'll make sure I try to cover it. So these are just 5 of the more popular strategies that we see and use every day. There are many, many more, but these are the main ones that we see most useful and again, implement frequently. So the first one is a charitable remainder trust. So what does that do? Well, that's making a gift to a charitable trust. And it could be your business, it could be real estate, it could be investment portfolio. Making a gift to that charitable remainder trust, and then the trust can sell that asset, we'll say if it's a business or real estate, and then invest that asset base with whatever the cash is into a diversified portfolio that then pays income back to the donor. So let's just say I give my business valued at $1 million to a charitable remainder trust. The trust then sells the business to the new owner. So they own the business. They contribute $1 million to the trust. We then invest the money in a diversified portfolio. And let's say it generates a 6% distribution. So now $60,000 a year is paid out of the trust to me, or me and my spouse, or me and my kids. There's a lot of flexibility. And then when we are gone, when we get promoted, the remainder goes to charity. That's why it's called a charitable remainder trust. Whatever's left after all the income has been distributed in all my lifetime, during my lifetime, whatever's left then goes to charity.
Yeah. And then what do we have with the donor advised fund?
Yep. So the donor advised fund is like I mentioned, is a pure giving fund. So whatever you give to a donor advised fund, you get a deduction on your charitable contribution based on the market value of the asset, the appraised value. You avoid the capital gain, and then whatever comes out of there, distributions, you can direct where the distributions go, but they have to go to charity. They can't come back to you personally. So that's a giving engine.
Can they go to a oh my goodness. Can they go to a family
foundation? Yes.
Yes. Sorry. Thank you for that, Paul. Yeah, I had a slight senior moment there, everybody. Thank you.
Yeah, no, great question. It's kind of a tricky nuance of the donor advised fund. You got to be careful. You don't want to abuse it because the IRS, will come check it out. But I could set up a donor advised fund. Actually, I've done this. Fund it with appreciated assets that I then sell. I did this with part of my business. And then I make distributions to a charity that my wife runs. And it's a qualified public charity. So it's an allowed gift. Supports her nonprofit. So again, I would say, make sure that you have good advice and you've got your ducks in a row, so to speak, and your I's dotted and your T's crossed. You don't want to be abusive. You don't want to do something that the IRS is going to disallow, because the taxes and penalties can be substantial. But it does allow some flexibility there with a family foundation or a charity, as long as it's an operating charity. It can't be a gifting or a funding charity.
Right. Let's before we go to the charitable pool trust, just to remind everybody again, chat box is down at the bottom if you want to ask a question. And the reason why we have Paul here and pool advisors and professionals here is that they have the information that we need. We don't do that here at Prometis Partners. Paul and his team do that kind of stuff. So if you have questions, certainly ask the questions here, or if you need to talk offline, we'll make sure we'll get a connection directly to Paul's office to schedule some time. So you want to make sure before you kind of go down any of these paths that you consult with people like Paul and an attorney to make sure like he said, you have everything in line prior to making a decision to make sure you qualify for this actual strategy. So go ahead, Paul. Let's talk a little bit about the charitable pool trust.
Yep. One of my favorite. So a charitable pool trust, typically we do that after the sale. And that's why we do so many of these, because a lot of times for various reasons, it's not possible or not able to do it pre-sale. Sometimes we miss the opportunity. Sometimes the opportunity isn't there, it doesn't exist. So a charitable pool trust is funded with cash. So that could be like you sell the business, you got a lump sum. I'm working with someone right now that sold their business for $10 million. They've got basically $10 million sitting in their checking account, right? So you give cash. You can give appreciated, publicly traded securities. So those are basically the only two things you can give to a charitable pooled trust. Well, why do I love it so much? Well, one, because it can be done post-sale and very effective. Two, it has a much bigger tax deduction than a charitable remainder trust. 2 to 4 times more tax benefits than a charitable remainder trust. And so it does a lot of the same things, but more tax benefits. And then the other thing is it's literally, I use the example of a faucet. You can literally turn the income on or turn it off based on how you invest the charitable pooled trust. So somebody that wants to grow the value and not draw income can invest it in growth investments, growth stocks, growth funds, and not have any income, not pay any tax. All that grows tax-free. When the point in time comes where they want income, then we turn the faucet on. And we do that by investing in income-oriented investments. So there's a lot of flexibility around more tax benefits, more income, or the ability to control the income for somebody that wants that additional leverage.
Yeah, that's an interesting strategy, Paul, that we'll have to certainly dive into a little bit more. But let's move on to the next one. Business giving engine.
Yep.
What do we have on that there?
That's again, we talked about this a little bit, so I won't go into a lot of detail, but it's where you use your business, giving part of it to a charitable trust, and then
Gotcha.
the income just becomes an asset that you can give away to charity.
Yeah, and I would think before we go to the last one on the charitable lead trust, depending on where your business is at today and where your business is down the road, there could be certain things you may do today. Yeah. And then as your business progresses in the future, you can always take a look at some other strategies to either piggyback on the one you have or to just move to a more advanced strategy, as you may call it, just to kind of move through it. So so let's talk a little bit about the charitable lead trust, Paul, and kind of help people understand, like, what does this do for people?
Sure. So a charitable lead trust is kind of opposite of the charitable remainder trust. So a charitable lead trust, you make a gift to a charitable trust. The income the trust generates goes to charity. So that's why they call it a lead trust. The lead is to the charities or charity that you choose. Could be your foundation, could be your donor advised fund, but that income goes to the charity. The remainder then goes either back to you, the donor, or to your family. So why is this good? Well, the lead trust allows you to get if the remainder goes back to you, you get a big tax deduction in the year you create the trust. You pay taxes on the income, even though it goes to charity, and then the asset comes back to you. So we see this being used when somebody has a really big income year for whatever reason. Could be a big bonus. A lot of corporate executives use these strategies because they get a $5 or $10 million bonus, and then they want to avoid the taxes. So they get a big deduction up front. The income goes out to charity, and then the money comes back to them, usually 5 or 10 years later. So it's a nice vehicle for tax planning. The other version is called a non-grantor. What that does is at the end of the trust term, the remainder goes to your heirs or your family. And so there's no deduction up front. There's income to charity tax-free, and then the remainder goes to your heirs. But here's the thing. There's no estate tax if you structure it properly. So we use it to avoid paying estate tax where somebody has a large estate. Like I mentioned, the one right now, $60 million estate. We're looking for ways of avoiding any estate tax. Well, the charitable lead trust is one of the better vehicles to do that. It's called a charitable lead non-grantor trust.
Awesome. Okay. All right. Well, let's kind of dive in over the last 10 or 15 minutes that we have here. At least let's go to the next slide. I think we have a case study. Again, if you have your questions, put those in on the chat box. We are watching that. We've had some great questions so far, and we want to make sure we answer any other questions that people may have. I know these are there's a lot of data here that we're going through. The purpose of the Owner Fireside Chats is to really start to get you a little bit more hungry, other than the lunch you have today sitting in front of you. But certainly, if you want to try to have a conversation with Paul, Lisa can certainly get you connected with Paul through an email introduction or something, and you guys can have a conversation offline. So we're going to talk about a charitable remainder trust warehouse property appraised at about $935,000. Paul, why don't you take it from there?
Sure. Yep. So there's two types of situations I tend to deal with. One is strategic and one is tactical. So tactical to me is, hey, I've got this asset or I've got this issue, help me with a solution. So it's very focused on a specific need or opportunity, and it's pretty straightforward. We just work through it. A strategic, I'll show you the next case is strategic, where we're looking at the whole picture. We're looking at everything that is going on in the client's life, and they want to bring together a comprehensive approach to stewardship and philanthropy and generosity. This is the tactical move. So client came to us, hey, we've got this asset. It's a warehouse. It's kind of old and run down. We aren't getting a lot of income because we're having to maintain the property. And quite frankly, the property isn't in great shape. So it's really draining us. So we get very little income. We have a very low basis, basically just about zero. They've they've depreciated the asset down to where there's almost no basis. Help us create a solution to get rid of this asset, not pay a lot of tax, but generate more income. Well, the way we did this, next slide, please. We gave 40% of the value of the asset. You can split the asset, 40% to a donor advised fund. So that's going to go to charity. And then 60% to a charitable remainder trust that pays a 5% distribution. So what does this do? Well, on the 40%, we avoid all the tax. On the 60%, we avoid any capital gain tax in the current year. Now, as the income comes out, that 5% distribution, there will be some tax on that, but it will be capital gain tax because that's the nature of the asset when we gave it to the charitable trust. So they love this solution because they avoided about $100,000 of capital gain tax. They got a charitable deduction between the two pieces of about $625,000, which they could use to offset other income as well as the income they were going to receive from the charitable trust. By the way, on deductions, you may not be able to use all that in the first year. You can carry those forward 5 additional years. So you get the deduction in the year you do it, and then the next 5 years. And they were able to get an income from the charitable trust of that 5%, which is $25,000 a year. So they increased their income, they eliminated a lot of tax, they avoided a lot of tax, and they got rid of a property that, quite frankly, was not ideal for them. You're muted, Vincent.
Sorry, I did that intentionally. So what a great way to kind of leverage some tax benefits and also create some retirement income. You're giving to charity. And so you're kind of accomplishing what looks like at least 3 or 4 different strategies within this one strategy, right?
Yep, exactly. Multiple goals and objectives. The donor was extremely happy, and it met all their needs and all their goals. And it even improved some of them. They were able to give more to charity than they thought they were going to be able to.
That's awesome. Okay. Do we have another case study?
Yep. The next one is a little more complex. Again, this is a strategic approach. So a client came to us. Thankfully, pre-sale. They had a business that they thought was worth maybe about 15 million. It was a C corp, which is really good to work with. They had very low basis, so it was all capital gain. They were ready to sell, and they wanted some help putting together a strategic plan. And as in many of these cases, when we're strategic, we ended up using 3 different strategies that I talked about before: the charitable remainder trust, the charitable pooled trust, or the charitable pooled income, and then the donor advised fund. So the blue boxes are those 3 charitable pieces. The one on the top left is what we refer to as an enhanced income trust. That's the charitable remainder trust. So they put about $6 million of the asset into that vehicle pre-sale. The one on the bottom left is the donor advised fund. They put $5 million of the asset pre-sale, and then the remaining portion of the stock they just sold outright. So they put 2 pieces in pre-sale, two portions of the stock, and then the third piece they just took cash. The business, by the way, ended up selling for 24 million, not 15 million, which is a lot of times what we see when we work with clients selling their business. I'm sure Vincent, you see this too. It's this goes back, I think, about 6 years, but there's still a lot of this going on where people are getting way more than they thought they were going to get. Capital is still fairly inexpensive, and so buyers are pretty aggressive with their bids. The third piece, the top right piece, is that charitable pooled trust, and that was what we put in after tax. We put $3 million in as a cash gift to get more tax deduction, more tax benefit, and also to generate income. So the top 2 on the left and right both generate income. The bottom one on the left is all to charity. So during their lifetime, just from the top 2, they have over 500,000 of lifetime income just from those 2 charitable trusts. Way more than they need, quite frankly. So they're giving a lot of that to charity as well. The fun thing is that all of it's growing faster than they can give it away. So today their net worth is with the charitable bucket included is worth more than 40 million, and they're trying to give away 2 million a year from the charitable pools that they've got in place. And even though they do it, it still grows. At least before this year, grew more than what they were giving away. So I won't go a whole lot more detail at this point. If you have any questions, please feel free to ask me. By the way, we presented this to their attorney and their CPA, and the attorney saw the tax savings. We saved them $8 million in taxes just on the sale of the business. And the attorney's comment was, I've never seen that kind of tax leverage.
Yeah, I think that's great, especially when you can get a compliment like that from other professionals. Was this a sale to the kids internally since it was a stock sale, Paul?
No, it was an external sale. Yeah.
Okay. All right. So one of the rare ones that go on a stock sale, but that's
Yeah.
fantastic.
Yeah.
Wonderful. So if anybody has any additional questions for Paul, please go ahead and feel free to put them in the chat box there. Paul, I want to thank you for your being here today and kind of going through this very important, certainly topic, and certainly we know it's complicated and can get really complicated just based on the size of the business and what the estate is. So if anybody has any questions or would like to reach out and connect with Paul and have a conversation, certainly let Lisa know and we can get you in contact with him. So again, Paul, thanks for being here today. Let's go to the next slide, Lisa.
Thanks for having me. And I would just say, Vincent, if anybody has any questions, go ahead and reach out, and I'd be happy to answer questions as best I can.
Yeah. Yep. Sure. Yep. So real quick is with the person that asked the question about the business at between 150 to 250 right now, should they just keep donating until they get above $3 to $5 million?
I would say so. Yeah. When you get above 3, then some of these things really make a lot more sense.
Yep. Wonderful. Yeah. And Robert, if you want to reach out and talk to Paul more independently, we certainly can get you his information and you can chat with him. But again, thanks, Paul. Next month in August, under the Prometis Partners Owners Fireside Chat, we have an attorney, Jody McLeod. She is going to be talking about working remotely. She has over 30 years of legal experience, both in private and public sectors, in this matter here. So I think this is going to be a very dynamic conversation also, especially with today, with everything, a lot of things going remote. Who should be going remote? How often should you go remote? What should the pay be? How do you set up these type of expectations and so on and so forth? So I think that'd be a great conversation. So we are at the end of our session today. Hope everybody had got some really good information out of it. You enjoyed your lunch while we were listening to Paul and really asking some great questions. Again, here's the email address if you want to have any additional questions or get in touch with Paul or ourselves. We appreciate you attending today, and hopefully that you can make the event in August. And again, Paul, thank you so much for being here. This will be has been recorded, and it will be up on YouTube here probably within the next day or so. So if you want to re-listen to it or parts of it, certainly it will be up there for your viewing pleasure. So again, thanks everybody, and have a great day. Thanks again.
Thanks.